Hi everybody, Jeff Yastine here, and you can write me, send me your emails and comments to this address, jeff@yastine.com, and you can follow me on Twitter, it's @Jeff Yastine, and on Facebook, the username is Jeff Yastine1. Well, electric vehicle stocks come in many shapes and sizes, but this powerful investing trend has a few other elements in common that tend to escape most investors, which is too bad, because for those investors who understand the connection here, it's a ticket, in my opinion, to a potential 100% gain on one stock that few people are looking at right now. And I see that gain over the next 12 to 18 months. Now, before I tell you the name of the stock, let's go over a couple of facts first as it relates to electric vehicles. Number one, we all know about the powerful electric motors behind today's battery-powered vehicles. But what connects those motors and the onboard electronics? Well, it's copper wiring, of course. The average battery electric vehicle contains about 180 pounds of copper. By comparison, the average gas-powered vehicle uses somewhere between 50 pounds to as little as 18 pounds of copper. So we're going to need a lot more copper in years to come. Number two, electric vehicles also require massive batteries, of course, and most use lithium. Now, one electric vehicle might have as much as 22 pounds of lithium, and nickel, though, is another growing battery metal with the need for smaller amounts of cobalt, cadmium, graphite, and silicon, of course. So let's think about where the world will be, let's say 10 years from now, if we're heading into an electric vehicle future, as I think most of us believe is happening here, and as most experts predict. We'll have 120 million electric vehicles worldwide by then. That's 12 times as many as we have right now. And according to the Woods Mackenzie consulting firm, that means that battery manufacturing will have to triple over this same time frame. It also means a likely quadrupling in the mining of lithium. And at present rates of nickel production, Tesla alone, for its production, might suck up half of the world's supply if it wants to meet its sales goals over the coming decade. That's just for Tesla. So folks, I think you know where I'm headed here. We're going to need a lot more copper, a lot more nickel, and many other industrial metals in order to transition into an electric vehicle future supplied by renewable energy resources. Now, how do we as investors and speculators profit from that knowledge? We do so by investing in a company like fluor, symbol FLR. Now, fluor is hardly a household name, but this company provides the manpower and expertise to build large-scale feats of industrial engineering. So if you want to build a mine of almost any kind, anywhere in the world, or construct, let's say, a battery factory, or any other kind of massive, technologically complex facility of almost any other kind, you contract with fluor to design and build that facility for you. Fluor also builds offshore wind farms and many other kinds of complexes related to the field of alternative energy. Now, industrial engineering firms like this one, like Fluor, have been on the outs with Wall Street literally for years now. In part, that's due to the decline in oil prices, because Fluor has long provided similar engineering and design services for petrochemical and refinery development. So as demand slid lower in the petroleum field, so did Fluor's once substantial profits and, of course, its stock price as well. But that trend is more than reflected, in my opinion, in the charts and also in the valuation of the stock, of Fluor's stock. Now, Fluor recently completed a top-to-bottom review of its entire corporate structure. It's been cutting jobs, it's been restating some financial numbers from prior years, and really rethinking how it bids on some kinds of multi-billion-dollar contracts, basically trying to be smarter about how it bids. As a result, the stock has started to move higher again, and in fact, the shares have basically tripled in price since the bottom of the pandemic back in March. And I think there's a lot more to go if we take a multi-month, multi-year view on the stock. Let's remember that a great many projects have been delayed because of the disruptions associated with the COVID-19 pandemic. As vaccinations continue over the coming year, corporations and governments will need to start putting those construction plans back into gear. Fluor's earnings are set to more than double over the next 2 years, rising from 64 cents a share this year to $1.30 by 2022, according to the projections of Wall Street analysts. As I noted earlier, global demand for metals of all kinds is going to rise substantially over the next decade. And Fluor will have plenty of work ahead, since it takes years and billions of dollars in contracts to put new mines and other kinds of electric vehicle related engineering infrastructure in place. So if you like where I'm going with this sort of thing, Fluor is the kind of stock you want to be paying attention to. Fluor will be getting even more reinvigorated in the coming year. It has a new CEO, David Constable, who's a longtime board member and formerly the CEO of the South African oil giant Sasol, who's taking up the reins of the company in January. Lastly, the stock remains undervalued and depressed, even after the sharp rise in the stock since early this year. At current prices, the shares have an average price to book value per share ratio of just 1.4 compared to the same metric of more than 3 just 6 years ago. So investors just don't want to pay very much to own the shares. And my bet is that Fluor's stock price will continue to rise in fits and starts in coming quarters as investors anticipate more billion-dollar contracts to keep the new electric vehicle global economy well supplied with industrial metals and renewable power in the coming decade. So that's something to think about. I don't see this stock as being some sort of rocket ship that's going to somehow, double overnight, of course. But again, we need to have the right mix of companies, and it's good to be able to buy undervalued companies as well as, the real high momentum growth companies. Have a good mix of them in your portfolio. So basically, you always have something working depending on what the overall view of the market is, because we all know sometimes the market wants to zoom forward and it's all about, future projections. And other times the market is less certain and they'll revert back to companies that have more value now versus the promise of great growth somewhere later down the road. Something to think about as we move forward here. If you like what I'm talking about, subscribe to our YouTube channel, follow me on Twitter and Facebook. I'm Jeff Yastine.